Welcome to Capital Investments, the channel where we discuss the most important investment topics to help you achieve financial freedom. In today's video, we will be discussing how the rich invest their money. We will explore the strategies that wealthy individuals use to grow their wealth and provide you with insights on how to invest like them. So, whether you're a beginner or an experienced investor, this video will provide you with valuable knowledge to help you achieve your financial goals. The wealthy have a different mindset and approach to investing than the average person. They understand the power of compound interest and focus on building wealth over time. They have a long-term view of their investments and are willing to take risks to achieve their financial goals. One of the key characteristics of the wealthy is their ability to delay gratification. They are willing to forego immediate consumption to invest in their future financial security. They are also able to control their emotions and avoid making impulsive investment decisions. Diversification is a key investment strategy that wealthy individuals use to reduce the overall risk in their portfolio. By spreading their investments across different asset classes, they can avoid having all their eggs in one basket and minimize the impact of market volatility on their portfolio. The wealthy understand that different asset classes have different risk and return characteristics, and therefore, they invest in a mix of stocks, bonds, real estate, and private equity. Stocks are a common asset class in which the wealthy invest, as they offer the potential for high returns. However, stocks can be volatile and unpredictable, which is why the wealthy also invest in other asset classes to balance their risk exposure. Within the stock market, wealthy investors stay diversified by investing in different sectors and regions. For example, they may invest in technology stocks as well as healthcare stocks, and they may invest in stocks from different countries to avoid overexposure to a single geographic region. This diversification helps to ensure that their portfolio is not overly exposed to any one company, industry, or market segment. In addition to stocks, wealthy investors often invest in bonds to provide stability to their portfolio. Bonds offer a fixed income stream and are generally less volatile than stocks. They also provide a hedge against inflation, which can erode the value of other investments. Bonds are typically less risky than stocks, but they also offer lower returns, which is why the wealthy invest in a mix of both asset classes to balance risk and return. Alternative asset classes such as commodities and precious metals are also popular among wealthy investors as a means of diversifying their portfolio. These assets often have a low correlation with traditional asset classes such as stocks and bonds, and therefore, they can provide additional diversification benefits. For example, when the stock market is performing poorly, commodities such as gold and silver may perform well, which can help offset losses in other parts of the portfolio. Real estate is a versatile investment that can offer a range of benefits to investors, particularly for the wealthy. Investing in real estate provides an opportunity for stable long-term returns, capital appreciation, and tax benefits. Many wealthy individuals have leveraged the potential of real estate to build their wealth over time. One popular strategy for investing in real estate is purchasing rental properties or commercial properties. This approach allows investors to generate regular income from tenants while also potentially benefiting from property value appreciation. However, owning and managing a rental property can be time-consuming and require significant financial resources. Another way that the wealthy invest in real estate is through real estate investment trusts, REITs, or real estate crowdfunding platforms. REITs are publicly traded companies that own and operate income-producing real estate properties, while real estate crowdfunding platforms allow investors to pool their money to invest in real estate projects. These options provide an opportunity for real estate investment with lower upfront costs and without the need for hands-on management. Some wealthy individuals may also choose to invest in real estate development projects or participate in real estate syndicates. Real estate development projects involve investing in the construction or renovation of properties with the aim of selling or renting them for profit. Real estate syndicates, on the other hand, are groups of investors who pool their resources to purchase or develop real estate properties. Regardless of the strategy chosen, it is crucial to conduct thorough due diligence before investing in any real estate opportunity. The wealthy understand the importance of partnering with experienced professionals, such as real estate agents, attorneys, and accountants, to ensure that the investment is sound and aligned with their goals. They also pay close attention to market trends, economic conditions, and regulatory changes that may impact the value of their real estate investments. Private equity is an investment strategy that has been widely utilized by wealthy individuals for many years. It involves investing in private companies that are not publicly traded. In essence, the goal of private equity investors is to help grow the company and eventually sell their shares at a higher price in the future. Private equity investments are often more complex than traditional investments in publicly traded stocks and bonds. They require more research, analysis, and due diligence to identify promising investment opportunities. Additionally, private equity investments often require a long-term commitment, with investors tying up their capital for several years before seeing a return on their investment. Despite these challenges, private equity investments can be highly rewarding if done correctly. Private equity investors have the potential to earn high returns due to the illiquidity of the investment, meaning that investors are often compensated with a higher rate of return for taking on the added risk. Wealthy individuals often invest in private equity through venture capital firms or private equity funds. Venture capital firms invest in early-stage companies with the potential for rapid growth, while private equity funds invest in more mature companies that are seeking to expand or restructure their operations. Both types of investments require a high degree of expertise and experience to identify promising investment opportunities and execute successful investment strategies. In addition to the potential for high returns, private equity investments can also provide investors with a degree of control over the company. Unlike investing in publicly traded stocks, private equity investors often have a say in the strategic direction of the company and can work closely with management to help grow the business. However, it's important to note that private equity investments can be risky and should only be considered by experienced investors who can afford to take on the added risk. Additionally, investors should be aware of the potential for conflicts of interest, as private equity firms may have different priorities than individual investors. Hedge funds are an investment vehicle that is highly sought after by wealthy individuals due to their potential for high returns and diversification benefits. These funds are managed by professional portfolio managers who use advanced investment strategies to generate returns that are not correlated with the broader market. One of the main advantages of hedge funds is their ability to generate positive returns even in a bear market. This is achieved through a variety of strategies such as short selling, options trading, and using leverage. These strategies allow hedge fund managers to profit from market downturns, while also benefiting from market upswings. Hedge funds often have high minimum investment requirements and are only available to accredited investors. Accredited investors are individuals or institutions who meet certain financial criteria, such as having a net worth of at least $1 million or an annual income of $200,000 or more. This exclusivity allows hedge funds to operate outside of the regulatory restrictions that govern traditional investment funds. Wealthy individuals may invest in hedge funds through a variety of structures, including funds of funds, managed accounts, or direct investments. A fund of funds is a hedge fund that invests in other hedge funds, providing investors with exposure to a diversified portfolio of funds. Managed accounts, on the other hand, allow investors to have their own dedicated hedge fund account managed by a professional portfolio manager. Direct investments in hedge funds provide investors with the opportunity to invest directly in a hedge fund, providing the potential for higher returns but also greater risk. If you found this information useful, please like and share this video, and don't forget to subscribe to our channel for more valuable content on business and investments.